All 12 members of the committee were in consensus. Decisions of the MPC. The committee decided as follows. 1. Reduce the monetary policy rate MPR by 50 basis points to 27%. 2. Adjust the standing facilities corridor around the MPR to plus 250 to minus 250 basis points. 3. Adjust the cash reserve requirements, CRR, for commercial banks to 45%, while retaining that of merchant banks at 16%. Also, to introduce a 75% CRR on non-TSA public sector deposits. And 4, keep the liquidity ratio unchanged at 30%. The committee's decision to lower the monetary policy rate was predicated on the sustained disinflation recorded in the past 5 months, projections of declining inflation for the rest of 2025, and the need to support economic recovery. The NPC also adjusted the standing facilities corridor to improve the efficiency of the interbank market and strengthen monetary policy transmission. The committee further introduced a 75% CRR on non-TSA public sector deposits for enhanced liquidity management. Considerations. The NPC expressed satisfaction with the prevailing macroeconomic stability evidenced by the improvements in several indicators. These include the sustained discipline, improved output growth, stable exchange rates, and robust external reserves. Particularly noted the increased momentum of disinflation in August 2025, being the highest in the past 5 months. This deceleration, underpinned by monetary policy tightening, exchange rate stability, increased capital inflows, and surplus current account balance, have helped to broadly anchor inflation expectations. Other factors that contributed to the deceleration include the continued moderation in the price of PMS and the notable increase in crude oil production. In the view of the committee, the stability in the macroeconomic environment offers some headroom to policy to support economic growth and recovery. Notwithstanding the consideration in inflation, the committee observed persistent buildup of excess liquidity in the banking system, resulting largely from fiscal releases emerging from improved revenues. Being mindful of the need to preserve the prevailing macroeconomic stability, the NPC noted the risks posed by the excess liquidity in the banking system. Members noted that effective functioning of the interbank market remains critical to enhance transmission of monetary policy. This, therefore, informed the decision to adjust the width of the standing facilities corridor to boost interbank market transactions and enhance the stability of the market. The committee acknowledged the continued stability of the foreign exchange market and its critical importance in achieving rapid disinflation, and therefore called on the bank to continue the implementation of policies that will further boost capital inflows and deepen foreign exchange. Okay. Financial sector, the NPC noted the continued resilience of the banking system, with most of the financial soundness indicators remaining within their respective prudential benchmarks. Lenders also acknowledge the significant progress in the capitalization exercise, fully met the new capital requirement. They therefore urge banks to continue the implementation of policies and initiatives that will ensure the successful completion of the ongoing recapitalization exercise. The committee further noted the successful termination of forbearance measures and waivers on single obligors, which has helped to promote transparency, risk management, and long-term financial stability in the banking system. The NPC reassured the public that the impact of the removal of forbearance is transitory and does not pose any threat to the soundness and stability of the banking system. Price and other domestic developments. Headline inflation year-on-year moderated further to 20.12% in August 2025 from 21.88% in July, a decline in both food and core inflation. On a month-on-month basis, headline inflation also decreased to 0.74% in August 2025 from 1.99% in the preceding month. Similarly, core inflation year-on-year eased to 20.33% in August 2025 from 21.33% in July due to the slowdown in the cost of services, housing and utilities, as well as transport and logistics. Food inflation year-on-year also moderated to 21.87% in August 2025 from 22.74% in July, attributed to the decline in the price of staples, especially rice, corn, maize, and millet. On output, the recently released GDP for the second quarter of 2025 showed the sustained resilience of the Nigerian economy with a real growth rate of 4.23% year-on-year compared to 3.13% in the first quarter of 2025. The committee particularly noted the significant improvement in the performance of the oil sector, which grew by 20.46% compared to 1.87% in the preceding quarter, a positive development that is expected to further bolster foreign exchange reserves and sustain stability in the foreign exchange market. In this regard, the committee commended the efforts of the federal government and called for continued vigilance to strengthen the momentum of security across the country in order to increase oil output and food production. Gross external reserve remained robust at $43.05 billion US dollars as at September 11, 2025, compared with $40.51 billion US dollars at the end of July 2025, with an import cover of 8.28 months. Similarly, the second quarter 2025 current account balance recorded a significant surplus of US dollars 5.28 billion compared with US dollars 2.85 billion first quarter. Global developments. Available projections indicate that global output recovery is expected to improve on the back of favorable trade negotiations and monetary policy easing, particularly in the advanced economies. However, persistent geographical tensions and lingering trade uncertainty disrupt global supply chain and dampen the output. Global inflation is projected to sustain its deceleration, albeit at a slower pace due to the impact of trade tariffs and other structural challenges. This trajectory has necessitated a cautious and data-dependent approach to monetary policy easing by central banks, especially in emerging markets and developing economies. Outlook. Staff projections suggest a sustained disinflation over the coming months, driven by the lagged effect of previous rate hikes, continued stability in the foreign exchange market, and decline in the price of PMs. Furthermore, the onset of the harvest season is expected to increase local food supplies, moderate food prices, and contribute to the overall decline in inflation. In its commitment to the core mandate of price stability, the committee will remain proactive in data-driven policy response. The next meeting of the committee is scheduled for Monday, 24th and Tuesday, 25th November 2025.